Do you know the biggest mistake people make when it comes to investing? Not doing it. I know it can be intimidating. The world of investing is full of confusing terms and opaque language. But with a little bit of education, it doesn't have to be scary. I promise. I'm going to teach you everything you need to know to start investing with confidence today. If you want more free education on how to save, invest, and make the most of your money, just hit the subscribe button and the bell, and you'll get a notification when we upload a new video. Hey, I'm Britt. I'm a Harvard Business School grad and money coach. I've been investing since I was 8 years old. And after college, I had a lot of friends asking me about how to start investing. Now that they were earning a steady paycheck, they wanted to know what to do with it. So I started a club to teach them how to manage their finances. It was like book club for money. The club ended up turning into Dow Janes, the financial education we've built to help thousands of women just like you learn how to invest their money and build their wealth. So before you start investing, there are some things you need to know. You know, people tend to get excited by the promises of investing, and they make the mistake of starting before they're ready. This can actually prevent them from getting any of the benefits from investing. It's like starting on a long road trip when the gas tank is nearly empty and the oil light is on. You're pretty much destined for a setback. So before you hit the accelerator on investing, I want you to ask yourself these two questions. The first is, do you have high interest rate debt? High interest rate debt is any debt with an APR over 7%. So if you have things like a student loan or a mortgage with a low interest rate, that doesn't count. It's okay to invest while you have those. If you have high interest rate debt like credit card debt, something that's like 20, 30%, you wanna make sure you pay that off before you start investing. And why is this important? This matters because you wanna make sure that your investments are earning more than your debt is costing you in interest. Otherwise, it's like trying to pour water into a cup that has a hole in the bottom. You're never gonna get any of the benefits. You're never gonna get ahead. Instead, it's just gonna keep holding you back. So you need to address that problem first. If you have high interest rate debt, stop, pay it off, and then come back and watch this video. If you do have high interest rate debt, we do have a bunch of free resources. You can check out our 5 days to debt-free training course, and we'll support you along the way. The link is in the description below. The second question to ask yourself is, do you have an emergency fund set aside? Having an emergency fund means you have enough money in your bank account to live off for the next 3 to 6 months. Why is this important? Well, you never know what life is gonna throw at you. You could lose your job, you could discover your house has termites, your kid could break his leg. You don't know when things are going to go wrong or what could happen. I mean, just think back to the global pandemic that hit us in 2020. And the thing about investments is they really start to pay off over a long period of time. And if you have to prematurely pull your money out of your investments to address an emergency, it can end up hurting you. For example, if your car breaks down while the market is low and you don't have enough money in your bank account to fix it, you may have to end up selling stocks while the market's down. And not only are you losing out on the long-term growth of that investment, but you actually could lose money on the individual stocks because the timing is so bad. So before you invest, you want to make sure you have your emergency fund first. We'll have a video coming out that explains more about how to start your emergency fund, and you can look for the link in the description below. Now, if you're already debt-free and have an emergency fund, go ahead and give this video a thumbs up so I know you're ready to start investing. And then let's dive in. There are a lot of different things you can invest in. You can invest in stocks, bonds, real estate, cryptocurrency, gold, lots of things. But today I'm gonna focus on stocks and bonds since you can invest in these pretty easily and you don't have to have a ton of market knowledge to do so. So quick overview of what stocks and bonds are before I tell you exactly what to invest in. A stock is a tiny piece of a publicly held company. So when you buy Google stock, you own a tiny piece of Google. And when the stock price of Google increases, the value of your stock increases. If the stock price goes up and you sell your stock, you make money. Stocks have historically returned 8 to 10% on average, which is a great investment. And to put that in comparison, the average home value increases 3.5% per year. So 8% is more than double that. And the reason the return is high is because the risk is also high. There's always the possibility that the company you invest in goes bankrupt and the value of your stock goes to zero. High risk, high return. That's how it works in investing. Bonds, on the other hand, are IOUs from a company or the government. So instead of going to a bank, the company or the government gets the money from investors who buy its bonds. And then the company or the government pays the bond back with interest, which is how you get your return. Bonds have historically returned around 4% on average, so about half the return of stocks. And that's because investing in bonds is less risky than stocks. So lower risk, lower return. Okay, now that you have a basic understanding of stocks and bonds, let's talk about how to actually invest in them. Now, the easiest way to invest without having to learn anything beyond what I just told you is to invest in something called target date funds. Target date funds are a mix of stocks and bonds, and the exact mix of stocks and bonds is based on your age, and it changes over time. So to choose a target date fund, you select the year you're planning to retire. Say you plan to retire in 2050, then you'll look for a target date fund 2050. You can do a simple Google search to find one, but pay attention to the fees. These are also called expense ratios. You don't want to pay more than 0.15% in fees for one of these target date funds. Now, there's a lot more I could teach you about investing, about index funds, mutual funds, ETFs, alternatives, diversification, and portfolio allocation, but I'm not going to. And the reason I'm not going to is because of what I told you in the very beginning of this video. The biggest mistake people make when it comes to investing is not investing. And the bottom line is the sooner you start investing, the longer your money has to grow. And the truth is, you don't need to know everything there is about investing to make a smart investment. So pick a target date fund and get invested today. Don't wait another minute. All right, 3 final investing tips to wrap things up. 1. Start as soon as possible. Investing is a long-term game. Your investments need time to grow. So as soon as you've paid off your high interest rate debt and saved your emergency fund, start investing. 2, don't make emotional decisions when it comes to your investments. This is a really common mistake. After the stock market crash in 2008, a lot of people pulled their money out after they watched prices plummet. But had they kept their money invested, that would have recovered. It would have more than recovered, and their money would have multiplied by now. Expect ups and downs and ride the waves of investing. Again, we're doing this for the long term. 3, diversify your portfolio. You've probably heard the Aesop's fable of the girl who put all her eggs in one basket, and while she's dreaming of all the things she's going to buy with the money she makes, she drops the basket. Don't make the mistake of putting all your eggs in one basket. Invest in high-risk options for a big payoff, but balance it with lower risks as a safety net. And don't worry, a target date fund does that for you. Finally, just so you know, you don't need a 6-figure salary or a ton of money in savings to start investing. It's okay to start small. Just start. It can be a turning point in your finances and in your life. So go get invested. And if you need some extra motivation, come check out our webinar, How to Think Like an Investor, where you'll learn even more about what you need to take on the mindset of an investor. I'll leave a link in the description below and hope to see you there.